Welcome back, my friends. Home prices continue to climb with striking regional differences, says S&P Case-Shiller. Prices nationally rose 0.7% month to month, seasonally adjusted. The index's 10-city composite fell 1%, year over year, slightly less than the 1.1% decrease in the previous month. The 20-city composite dropped 1.7%, the same as the annual decline in April. The shortage of houses is hitting some people in areas harder than others. The supply of homes for sale in the US is about half of what it was in 2019. The shortage is hitting some buyers more than others, based on income and area. Far fewer homes are available to people who make $100,000 a year than just a few years ago. What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities, and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the doctor knows the patient identity. Home prices in May rose for the fourth straight month on the S&P CoreLogic Case-Shiller Home Price Index, but regional differences are widening. The gains come despite a sharp jump in mortgage interest rates during the month. Prices nationally rose 0.7% month to month, seasonally adjusted. The index's 10-city composite gained 1.1%, and the 20-city composite gained 1%. Prices nationally were still down 0.5% compared with May 2022, but they are just 1% below their June 2022 peak. The 10-city composite fell 1%, year over year, slightly less than the 1.1% decrease in the previous month. The 20-city composite dropped 1.7%, the same as the annual decline in April. Home prices in the US began to fall after June 2022, and May's data bolster the case that the final month of the decline was January 2023, said Craig Lazzaro, managing director at the S&P DJI. Granted, the last 4 months' price gains could be truncated by increases in mortgage rates or by general economic weakness. But the breadth and strength of May's report are consistent with an optimistic view of future months. Lazzaro, however, noted that regional differences continue to be striking, with cities in the so-called Rust Belt outperforming the rest of the nation. Prices in Chicago gained 4.6%, in Cleveland, 3.9%, and New York, 3.5%, making for the top performers. The Midwest took over the South's reign as the strongest region. It's been 5 years to the month since a cold weather city held the top spot, and that was Seattle, which isn't all that cold, added Lazzaro. Of the 20-city composite, 10 cities saw lower prices in the year ended May 2023 versus the year ended April 2023, and 10 saw higher prices. Cities in the West, where prices had inflated the most, were the worst performers in May. Seattle, down 11.3%, and San Francisco, down 11%, were the worst. Prices are rising again because supply is still very low. Current homeowners are reluctant to sell, given that most are paying mortgage rates that are less than half of today's rates. Demand returned after the initial jump in mortgage rates, as buyers seem to be getting used to a new normal. The housing market remains unaffordable for many buyers, but some areas are seeing high levels of competition as a result of low for sale inventory, said Hannah Jones, research analyst at Realtor.com. Limited existing home stock means many markets are seeing competition reminiscent of the last few years. Even in a housing market that has slowed significantly due to rising mortgage rates, the supply of homes for sale is about half of what it was in 2019. The shortage is hitting some buyers more than others. The popular 30-year fixed mortgage rate hovered in the high 6% range in May. At that level, buyers with an annual income of $100,000, slightly above the national median, could afford a house with a maximum price of about $341,000. But just 39% of the homes for sale were listed at or below that price point in May, according to a new report Thursday from Realtor.com with the National Association of Realtors. In a balanced market of supply and demand, 64% of homes should be affordable to buyers who make $100,000 a year, given the size of that population. As a result, the market currently lacks about 285,000 of those listings. Just 5 years ago, those same earners could afford 2/3 of homes for sale. Home prices and mortgage rates were significantly lower. The lack of affordable homes heated up competition in the market this spring, which reversed the cool down in home prices that started last summer. It's almost a tale of two cities where we have houses under $500,000, they're absolutely selling incredibly fast. Under $350,000 and $400,000, there's multiple offers, said Noah Herrera, a real estate agent in Las Vegas, during an open house in mid-May. Over $500,000, it slows down a little bit. At the higher price ranges, too many homes are for sale for the number of Americans who can afford them. In fact, for every home listing above $680,000, the market is lacking twice as many homes under $341,000. Ongoing high housing costs and the scarcity of available homes continues to present budget challenges for many prospective buyers, and it's likely keeping some buyers in the rental market or on the sidelines and delaying their purchase until conditions improve, said Realtor.com's chief economist Danielle Hale. The pricey existing home market is pushing more buyers to new construction, which, ironically, used to come at a price premium. Home builders have been offering incentives such as upgrades or temporary mortgage rate buydowns. Those, however, are decreasing as builders see more demand and gain more pricing power. As with all else in real estate, location is everything. Areas in the Midwest continue to have the highest number of affordable homes. The 4 cities with the largest supply of affordable homes are all in Ohio. They are followed by some others: Syracuse, New York; Pittsburgh, Pennsylvania; and St. Louis, Missouri. Some analysts are warning us to get ready for corporate landlording by Wall Street. Corporate and institutional investors are preparing to become even bigger landlords. The United States is teetering on the brink of a recession. And, a record number of new houses are coming onto the market in many cities. Wall Street has purchased hundreds of thousands single-family homes since the Great Recession. Home buying corporations are backed by private equity groups like Blackstone and Pretium Partners. These financial giants bought tens of thousands of homes across the U.S. Sun Belt. And these are detached, single-family houses. That has caused prices to increase more quickly in key Sun Belt states as compared to the national average. Analysts warn that institutional investors will control a large market share in housing within a few years. Specifically, institutional investors may control 40% of U.S. single-family rental homes by 2030. Some Washington lawmakers believe that Wall Street needs to back away from the market. It was that rare opportunity that attracted the institutions to build a portfolio out of these foreclosed properties, said Stephen Xiao, professor of finance and managerial economics at the University of Texas at Dallas. Since the early 2010s, financial giants have bought in. They've also added to the housing supply in some cases with built-for-rent communities. Some of these companies are financed by private equity firms and investment managers. Even if institutional investors only buy up a small percentage of total housing, their presence in the bidding wars can still lead to higher costs for all buyers. Home builders are looking to sell unsold homes in bulk to institutional landlords. And institutional and corporate buyers are raising funds of over $100 billion. They are preparing to pour billions of dollars into new build-to-rent communities. Tricon Residential has nearly $3 billion it plans to use to buy and build new homes. J.P. Morgan Chase has formed a new venture with a billion-dollar real estate developer. The partnership is morphing America's largest bank, America's largest landlord. This starts with thousands of U.S. rental homes. J.P. Morgan announced that it has formed a joint venture with Haven Realty Capital. The joint venture will purchase and develop entire communities of new homes. It is starting with 3 communities in the Atlanta area. A community is far easier to manage than a disparate group of properties spread across multiple parts of a city. Under the BTR model, housing developments are built on spec, which means without an agreed buyer. The builder tries to get a property management company to buy the entire community of houses as a block. Then, the property management company rents out and maintains all of the community's properties. The amount of rental houses increases when property prices and mortgage rates soar. Haven already owns 3,500 homes valued at $1.2 billion in 35 communities. Most of these houses are completed. J.P. Morgan's injection of capital could increase that portfolio by 70%. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.